If you come from a community where money was always tight, patience wasn't a strategy, it was a risk. So when you see mining stocks and they don't move right away, it feels like yet another system that just isn't working for you. This video is going to explain why that feeling makes total sense, and more importantly, why this time things might be different. First, a quick reminder, this content is for educational purposes only. It is not financial advice. Hey everyone, I'm JP. I used to be a banker, an insider, and now I'm here to break down how money and markets really work. This channel exists because most people were never shown how long-term wealth is actually built, especially in communities that were historically locked out of opportunity. So let's get into it. Why do mining stocks feel so personal, almost unfair? It's because they frustrate people. They don't reward urgency, and urgency is something many of us learned very early on in life, simply because waiting wasn't an option. Bills don't wait. Rent doesn't wait. Life doesn't wait for anyone. We're trained to act now, to solve the immediate problem. So when we look at an investment, our instinct is to expect immediate results. But mining stocks require patience, not because they're broken, but because of how big money, how capital, actually moves. Look at this chart. You can see the price of gold going up, but the mining stocks that dig it out of the ground are lagging behind. Now, most people look at this gap and see failure. They think, I was told this would go up. It's not. I'm getting out. But this gap isn't failure. It's sequencing. It's a natural part of the process that big institutions understand. But most regular people were never taught. And that brings me to the next crucial point. Something most people, especially outside of wealthy circles, never get taught. Price does not equal profit. Just because the price of something like gold is rising, it doesn't automatically mean a rising opportunity for the companies that produce it. Why? Well, there are a few simple reasons. First, costs. A mining company's expenses, like fuel, labor, and equipment, might also be going up. Second is timing. They might have sold their future production at a lower price before the big run-up. And third is profit visibility. Big institutional investors, the ones with billions of dollars, need to see consistent profits over several quarters before they're willing to invest. They need proof. So institutions wait because they can afford to. They have the luxury of patience. Most communities, on the other hand, were taught to chase returns. We see a price going up and we jump in, hoping to catch the wave. We weren't taught to understand the underlying cycles of a business. Look at this chart here. It shows the price moving first, and then, only later, do the profit margins start to expand. That delay is where most people get shaken out, while the big money is just getting ready to step in. This brings us to what I call the repricing moment. This is where your patience gets paid. Once the gold price stabilizes at a high level and the company's costs are understood, and those profit margins become clear and predictable, capital moves in, and it moves in fast. This is the moment where generational wealth starts to separate from paycheck to paycheck wealth. The people who benefit here aren't the ones who got lucky. They're the ones who were informed. They understood the sequence. This chart shows it perfectly. You see the mining stocks lagging, and then boom, a sharp repricing upwards. We're not talking about small gains here. We're emphasizing the percentage move. This is how a portfolio can change dramatically, not by chasing hype, but by understanding the process. Now, let's talk about volatility. Those wild up and down swings that scare so many people away. Volatility isn't random. Volatility exists to test conviction. It is a mechanism that pushes out the people who need immediate results and are emotionally unprepared for the ride. And in turn, it rewards those who understand the process and have the patience to see it through. So I want you to reframe this. Volatility isn't a punishment. It's the cost of entry. It's the price you pay for the opportunity to participate in that major repricing moment. If there were no volatility, everyone would do it, and the massive returns wouldn't exist. So here's my message to you, to our community. For all of us who were told that investing wasn't for us, that it was too complicated or a game for the rich, understanding these cycles is power. It levels the playing field. This isn't about trying to time the market perfectly, because nobody can do that. It's about understanding the sequence of events so that you are no longer surprised by them. It's about seeing a lag not as a failure, but as an opportunity taking shape. It's about seeing volatility not as a threat, but as the gatekeeper to potential rewards. Because knowledge compounds. If you want clarity instead of hype, you're looking for understanding instead of fear, then you're in the right place. Thanks for watching. There's a lot more to come, so make sure you subscribe.